This Money Tuesday, we continue a series trying to help you understand investing. That includes how to navigate unexpected developments. Case in point, China revealing DeepSeek's advanced AI, causing NVIDIA stocks and other tech stocks to tumble yesterday. Joining us now, financial expert Marshall Clay with the Welch Group, in an effort to help these first-time investors understand the stock market, which has these movements up and down all the time.
That's right, and I think it's a key for our viewers to understand that the market is pricing the future, not necessarily the present. So everyone who's investing is trying to anticipate where things are going in the future. And so in the short run, the market, market prices trade on a lot of feeling, a lot of sentiment, a lot of belief about how things are going to play out. And then of course, longer term, it's really about those underlying fundamentals. And so when you get a day like yesterday, there was a lot of optimism built up in the market around these technology companies. And when you have a news story about DeepSeek coming out saying that, hey, they did something at much cheaper, which is going to call into question energy demand, you're going to see really good companies like NVIDIA drop 15, 20%. A lot of energy companies that were expecting the demand for energy around AI to increase dramatically were down 5 to 10% as well. So it's important for our viewers to understand that when they're designing their portfolios, to be aware of how the market actually moves, both on the short term and the long term.
And then how should they position themselves so that they're not impacted as greatly one way or the other?
Yeah, so I think the first thing is just to realize that markets can be irrational sometimes. They can be irrational not only to the downside, okay, in these really negative market sell-offs, like if you remember during the COVID-19 crisis, I mean, there was some irrational moves to the downside, but they can also be irrational to the upside. And sometimes markets get way ahead of themselves and they have to correct. And so a day like yesterday is just a reminder of that. Also, I think that fear can be more powerful than greed. And so what I mean by that is you see the market a lot of times will sort of inch its way up over a period of, maybe a couple of years, 2 to 3 years, and then you'll get a day like yesterday where the market takes the elevator straight down. And so being mindful of that and managing your risk as you go along. And I know a lot of our viewers don't necessarily have the opportunity to invest in individual companies or build individual stock portfolios. They're confined to, maybe a menu of options within their 401k. And I would encourage our viewers to not just blindly put their money in target dated funds or just the S&P 500 index. Okay. There may be some other options within their 401k plan that offer maybe more equal weight exposure to the NVIDIAs, the Microsofts, a lot of these companies that have maybe gotten a little bit ahead of themselves in terms of price.
A lot of these people who go in their 401ks, or they don't have really a financial consultation with somebody, and they're just looking for something. So you just mentioned, don't do S&P 500, just a regular index fund right now, because it's not good. And don't do some stocks that are targeted on a date on retirement. So then what should they look for? Should they look at 5-year rate of return, 10-year rate of return?
Yes, I think it's very easy to do those target date funds because most people just don't want to think about this, right? And so that's why they created these type funds. But I think just looking at, a lot of times they'll offer the target date funds and then they'll offer the underlying individual funds themselves. And so it does require a little bit of homework to actually look in and understand the underlying investments within these funds and how these funds are weighting their investments. So for example, the S&P 500, they're a market cap weighted index. And so you see now that the top 10 largest companies in the world make up a huge part of that index. Now that's not necessarily a bad thing. I'm not necessarily telling everybody to go out and sell their S&P 500 index, but just maybe limit the exposure to that. Maybe look for some other options that diversify the investments a little more, because when these things get a little bit out of whack, you can get these really violent corrections that can cause you to really question your investment.
All right, I know that's a lot of information, but obviously, as Marshall just said, do your homework on this and do a little research, or maybe get some help with a financial expert on that.
Absolutely.
Appreciate it.